Welcome everyone, hope you're well. We're going to do something a little bit different today, and we're going to step away from the charts entirely, and we're going to run through a presentation that I've put together to discuss risk management and why journaling matters. I feel it's a point that really no one discusses well enough, uh, in especially the YouTube space or in general. There's a host of traders that do not journal at all. Now I know this is a very dry topic, so we're going to try and make this a little bit fun, not make it extremely boring, but you need to understand that this is extremely important in order for you to have success in trading, especially for the long term. This is what is expected in any business. You need to know your numbers, you need to be able to forecast, and you need to be able to withstand different business and market cycles. Okay, so we're going to run through this presentation. If you want to, before you jump into this, get yourself a coffee, get a pen and paper, and let's get cracking. Okay, so what we're going to cover here is we are going to cover sample size and why it's important. Okay, and what actually is a decent enough sample size for you to determine an edge. We're going to discuss the most common thing that everyone looks at, which is your strike or win rate, and your rate of return, or otherwise known as your risk to reward. And we're going to look at, once you've got a significant sample, how you can tweak your numbers for better performance and improve your profitability, things that you need to be thinking about. And I'm going to run over some of the products that I trade, but it's crucial for you to be aware of the product and understand it, that you're trading. Okay, and we'll run through what I mean by that when we get to that specific slide. And then we're also going to have a look at my journal, and for specifically catering to the June results. Okay, as I feel it's a good time. I was doing this anyways, and I thought it would be definitely beneficial for everyone in the community and anyone that comes across this video, where we can actually drill down into some numbers. Okay, so let's get cracking. So you need to think about, with regards to sample size, okay, this all comes into play with your trade frequency. So a lot of us are day trading, so we're typically going to be taking somewhere between 5 to 10 trades a day, give or take. You could be taking less than that, more if you are taking a more position day trade as such. So we're going to run down why it's important and how do we ultimately measure the sample size. So there's specific statistical formulas that you can essentially use to your advantage, and of course when it comes to stats, what gives you a statistical edge for you, where it's going to be in a 70% or 90% confidence interval. Okay, so we're going to jump into this now. So in essence, with your sample size, now this is readily available online. You can find this data, but this gives you an idea, so you can plug in your own numbers. If you bring up a scientific calculator, you essentially just use these numbers, and you would then adjust the 0.5 here, where the 0.5 is in essence is your projected win rate, and it gives you an idea on what your sample size needs to be in order to give you a confident edge on that actually being not just luck. Okay, so we can see here that in order for you to have a 50% win rate with a 70% chance of that being the case, you need to have 107 trades in your sample size. In order for you to have a 95% confidence level, you need to have 385. Now, as soon as you start increasing your win rate, um, these numbers increase quite a lot. If you're going for, say, 65%, you're probably going to be up at the 600s plus trades, roughly speaking, when I've done these numbers myself. Okay. Now, sample size is extremely important because it gives you the confidence in your data in order for you to execute and be able to step up and take a position without hesitation and without fear. Okay, so when whatever your specific setup is, and to be honest, this is not about strategy, this is about the behavior for you clicking the buttons. I couldn't really care less if you're, betting on two flies running up a wall, or you're taking MACD crosses or whatever. Regardless of what it is, you need to know how your behavior is when you are executing those positions to determine how you're managing them, and we can run into the different tweaking that you can carry out to essentially improve your edge. Okay, because when you've got a significant number of trades under your belt, not only do you get to see your edge occur when it appears, whether that be with the depth of market, with order flow, and actually the entries and exits around that, you actually have the data behind you to provide you confidence. Because in trading, we essentially show up every day uh, with the opportunity to make money on betting on the future, right? Which is a crazy concept. So you need to be making sure that you've got data behind you, that you've got an edge to back it up, and it gives you confidence when you're executing. It's very, very important. Okay? Because if you're not journaling, I say this a lot on stream, but if you're not journaling, you really, really struggle with recency bias. And essentially, recency bias means that if you have a series of losing trades, you will simply only remember those losing trades, and some people then have the tendency to then just move and change strategy. Okay, which obviously is very counterproductive, because when you've got a large sample size and you have a series of 3 or 4 losing trades, it's absolutely meaningless in the grand scheme of things when you need to be looking at a sample size over at least, let's say, 100 trades, for example. Now, I'm a firm believer of 30 is a good starting point if you're new to this and you've not really got a strategy or an edge, or you don't even really know what we're talking about. Start with 30, see how you're doing, and then adjust it as you see fit. Okay, but you really need to be playing this out over a period of time to get a decent sample, and all of that factors into your trade frequency as well. So trade frequency, if you're scalping and you're doing order flow and you're in and out maybe 5 to 10 trades a day, then you're obviously going to have a bigger sample size than someone that is maybe looking to only fade the high and lows sweeps back into value. So you need to take that into consideration as well. Okay. So now that we've carried out the sample size, and I hopefully that gives you some clarity on the number of trades that allows you to gain some confidence in your trading, and it should give you much more better control when you're executing, because you're not only relying on the data you're seeing on the screen, you've got the numbers behind you as well. Okay, so strike rate and risk, return on risk. Okay, the most common one that everyone looks at, which is known as your risk to reward. Okay, so very typically you fall into one of two camps here, very very simply. So you're either going to have a higher strike rate and a higher win rate and a less return on risk, or you're going to have a lower strike rate and a higher return on risk. Okay, so that's pretty much the two camps. Regardless of what strategies you're trading, again, that is absolutely meaningless for this conversation that we're having right now. Okay, very typically, from the numbers that I've looked at traders over the number of years that I've been involved in markets, When people start out, they typically have a much higher win rate. Now, there's nothing wrong with this. It's just the different stages. They have a much higher win rate, and they typically have a less than one risk to reward. And the reason being is it's much easier psychologically to win and take less out the market than it is to consistently lose on trades and then have a much bigger win when you do actually hit that winning trade. Okay, and also it depends if you're, well, majority of people are trading prop, so I actually think that anything above probably 2 to 1 risk to reward for prop trading is probably not sustainable, just because you don't really have the room to maneuver with the drawdown limits that are put in place. So very typically, you're going to be somewhere in the, for the 1 to 1 and less risk to rewards. You're going to be sitting in the sort of 65 to 70% win rates, and you're going to be looking to take somewhere between 1 to 1.5 R on your returns. Okay, and then if you're on the higher end of that, when you get to the 2 to 1, you're probably going to be sitting around about the 45% win rate, potentially 50%. You're obviously going to have outliers in this, but the thing is, as a bigger sample size comes into play, the more these numbers tend to balance out. Okay. And another thing as well that you need to consider regarding this is, of course, the tick to commission ratio for the product that you trade. We've covered this in our previous videos, which I'll link in the description, which is regarding which markets and products you should be trading. But in essence, if you are trading more frequently, the cost of doing business and platform fees is extremely important. Okay, especially when you're trading something like the NQ or ES, where you're pretty much talking, $4.50 a round turn. Once you move across to your personal account and you start slinging some size, you'll be able to get that down. You could potentially look at leasing a seat as well to reduce that. But then, of course, you have professional fees that you need to pay to factor everything in. But you need to look at your trade frequency, and that needs to factor into your overall profitability numbers. Okay, and essentially your commissions and your strike rate and return on risk essentially makes up your profit factor number. Okay, the three of those numbers that combine. Now, profit factors are going to vary. As long as you're going to be obviously above 1, then you're in essence going to be making margin, and you're going to be getting a return on your investment. I think if you're shooting somewhere between 1.2 to 1.5 is sustainable. I think it's very hard to maintain above 2 consistently for day trading. Would be if you're probably going into the swing side, but we're not really in the swing trading camp here. So all of this you need to take into consideration. Okay, so when you're working this out, you need to have a look at your journal and see what is your current strike rate, what is your current rate of return when you're actually winning trades, what is your average losing trade. Okay, and you need to factor all this in when you're building your methodology for this, because as I've stated in previous videos, that you should actually be doing this first before you jump into the next, volume profile, MACD cross, insert random trading strategy that you find on YouTube that someone is touting. Okay, as we know, YouTube is pretty much it's just a minefield of nonsense a lot of the time. Okay, and we're trying to create a place here where we're using stats as an edge as well. You need to know yourself, and as we've discussed in previous streams as well, that when you tend to find this channel, You essentially have been through the ringer a little bit. So we don't teach, what's a candlestick on here, So it's good that you guys have found this video, and hopefully as we gradually work through the slides here, you can start to formulate a different perspective on the market, and it will allow you to control those down days and to start viewing things over the next coming months instead of the boom and bust phase that a lot of traders go through. Okay. Because ultimately, the main reason for this data and knowing these numbers is obviously to increase your profitability, but the main thing is your psychology. So if you would be able to execute and hold your trades and be able to have the confidence in yourself, if you have data behind you. So it's very, very important. Okay. So another thing that once you start building up a decent sample of trades, okay, you can start looking to tweak these numbers. And the first thing that I look at is the max adverse excursion and the max favourable excursion. I've actually just noticed there's a slight error here in the title, but that's okay. We'll crack on. So essentially, your max adverse excursion tells you in a specific trade how many ticks did that go against you, and your max favourable excursion lets you know how many ticks did that trade go in your favour. Pretty straightforward stuff. You can see it as your opening profit for that trade, or your unrealized profit, or your unrealized loss. Okay, and essentially once you build up a decent enough sample size, you can adjust these numbers. And what do I mean by that? Well, if you realize that when you lose a trade, okay, and say you've got a 10 tick stop, you realize that once you go 8 ticks against you, it never really comes back. Okay, so you're then just taking an extra 2 ticks of loss for the sake of it. Okay, so it means that over a significant sample size, you can then get to reduce your stop loss or your number of ticks to realize that the trade is correct by a few ticks. And as you see, when you start thinking about this over a longer period of time, reducing your number of ticks in a losing trade is massive. So if you do that over the next 500 trades, say you're going to lose 100 of them, okay, just as an example, if you can reduce that by 2 ticks, you've just saved yourself a couple hundred ticks, which over the course of a year basically can cover your commissions, as an example. So all these little small tweaks and adjustments that you can do really, really helps your profitability. But the only way that you can do that is if you know the numbers and you know the data. Because if you don't do that, you're gonna suffer again from recency bias. Okay. And the same thing also could be seen on the profit side. Okay, so are you potentially not letting your winners run that little bit? The max favourable excursion actually takes into consideration, when you've closed it, did you take the max highs on that, the P&L high, or could you have potentially got an extra 3 and 4 ticks? What percentage of occurrence does that happen, and how does that factor into your profitability? Okay, but again, you need data. So this is important. If you're not tracking these numbers, you need to start thinking about it, get it into your head, so that you can start monitoring your positions a little bit more. Okay. Now, we also want to go into the product that you specifically trade. Now, I gradually over time have been shifting more towards treasuries, just to the fact that the book is thicker. And when I was more ES specialist, the book was much thicker then, and now it's just not really conducive to how I trade. So I'm switching more to a thicker market. But anyway, this is not about me. So with regards to understanding the product that you're trading, whether that be NQ, ES, commodities, flies running up a wall, or lean hogs, whatever. Okay, you need to be noting in your journal so that you build up a decent enough sample to say, right, what happens? Do we typically balance around on days prior to large news events coming out? So, for example, when FOMC meetings happen, or the CPI prints, or there's GDP final reports coming out, what typically happens? The days leading up to that. Do we typically extend ATRs or the average daily range, or do we not? Do we typically balance? Do we not? Over time, you should be building up a decent sample size on this data, so that it gives you more clarity on the probabilities of you fading an extreme back into value on these specific types of days. Okay. Now, all of that is we really harp on about in the streams is context. Okay, if there's no news on a Monday, right, and it's lunchtime, for example, in the US, and there's no news expected in the calendar, we're approaching the high of day at an extreme. Okay, what is the probability that that is going to break through the highs and continually making higher highs at lunchtime on a Monday, where there is no data on that specific day coming out? The chances is it is more probable that it's going to revert back to the mean than it is to continually smash highs and continue on. Okay. Now, this you're only going to know that if you start journaling and making notes on the occurrences that this happens. Okay, and this can be the same for your trending days. How frequently, on the flip side, how frequently does it trend on those specific days? And normally price discovery happens when large news events come out and data points somewhat shock the market. Um, so so you need to be noting these things, because the more notes you take and the more you understand your product, um, just the better equipped you become. Nothing then becomes a surprise, because you say, okay, well, that happens X amount of times, so we'll just chalk it into that. Okay. And also, as another thing, I keep extensive stats on a lot of the products I trade. We discussed this in the Discord recently, but it's nothing really to do with the strategy per se. It's just knowing and being in tune with the actual product that you trade. So we'll use an example of this being the average daily range of the product that you trade. I will take into account ZB, which is the 30-year bond. Over the course of the last 1,000 trading days in occurrences, the average in ticks is 43 ticks. Okay, one standard deviation of this is 22 ticks. Now, there's a little bit of rounding here. You can kind of say 44 and 22, but give or take. Okay. Now, I can tell you from out of 1,000 occurrences, 14.72% of the time, the market extends above 65 ticks, right? Which essentially is the ATR plus a standard deviation. Okay, that happens 14.72% of the time. And then on the flip side, how many days do we actually have a less than standard deviation move? Well, that's only 7.58% of the time. So what that tells me is 77% of the time within the last 1,000 trading days, we've been in a range of 22 to 65 ticks. Okay, now you can obviously see that knowing this specific data can provide you an edge. Okay, when you then factor that into context, and you factor that into your order flow strategies and whatever which way you're executing, I'm pretty sure that people can come up with a strategy to somehow find 3 or 4 tick moves on these specific day types. Okay, but we're then back to the main point here of you need to know these numbers. okay, for the specific products that you trade. You're at a disadvantage if you don't, because the algorithms that are trading, they know this, and they also know um, tons of other data. They are tracking if um, from an ATR move and a standard move on a lower time frame, is the market too long or too short? And then they whip it back into value all the time. That's where you see these sudden moves pulled back and forward on the tape that you will look at. But I'm going into context of strategy, which is not there. But you can understand the reasoning behind wanting to know this data for the product, because then you can formulate your strategy, and again it gives you more confidence in actually executing your positions, which is why we're doing this. This is the whole point, because majority of the time people can't make it in trading because they can't execute worth of shit. Okay, that's the problem. You can give someone the holy grail of strategies, but the trouble is, they'll end up scaling into to losing trades. They'll end up doubling down, and then they'll end up nuking their account, for example, or they can't sustain any downside, and then they end up blowing up. It's very, very common, right? And typically traders go through a boom and bust phase until they end up controlling the risk. That is typically how it works. I've done it in the past as well. When I started, I kept on having these boom and bust phases where I would make a ton of money and then I would give back tons, rather than just seeing it as a continual slow grind. I'm not going to use the word base hits, but it should just be when you come in of a specific day and you turn on the screens, you have an idea of what your max loss is going to be for that day and what your max win is going to be. And if you don't have an idea of what your max win is going to be, and you don't have an idea what your max loss is going to be, you end up having these big swings. Okay? And in my opinion, it's better to have capped upside days, right, while also having capped downside days, because then you're always going to be there tomorrow, and you can then start forecasting your trades, and you can work on your performance over the next month, and the coming quarters, to help improve your win rate and improve your profitability. Okay, but hopefully this makes sense, because if you start understanding these numbers more, it will literally change your trading outlook and perspective. Okay, so my journal. This is specifically for the month of June. Okay, now, never really a fan of putting this type of shit online, so I hope you guys appreciate me running through this. Okay, so I do this on a monthly basis. I have a specific criteria where I log my trades on a day-to-day basis. I make notes on what happened in that day, if I traded like a dick or not. And also I know if we've finished in balance, what happened with the VPOC, so on and so forth. At the end of the day, my journal is my journal. You need to create your own. It's your own behavior. What I do in my specific execution and trades is got absolutely nothing to do with the profitability of you. Okay? So I'm just using this as an example of how I look to measure my performance, what I do to try and tweak it, and areas to improve on. Okay, so this is for the month of June. We can see I carried out 194 trades. My profit factor was 1.32, so could be a little bit higher, but it was, it's the summer months, and I found the last week specifically pretty challenging. My win rate is, just approaching 65%. My loss rate is 21.6%. The difference between the win and loss is, to get to 100% is the break even. And essentially, I take quite a few break evens in treasuries, because if I'm offside a couple of ticks, it sometimes comes back. And then I'll scratch and then look to get back into those trades. Okay, and in this month, my return for my account was 2.6k. Not too bad, not fantastic, not great, not terrible, but it's still profitability at the end of the day. This does not take into account my other prop and so on and so forth. Now, I also track my max consecutive wins and my max consecutive losing trades. we can see I've had 10 wins consecutively and 3 losses. Okay, and this is, by the way, is actually consistent over my whole sample size, not just this specific month. Okay, so overall, I make a report on how did I perform. Was it one specific or a few specific days that basically took this down? In this actual occasion, the answer is yes. I had a couple of days where I took my personal max loss and basically was stubborn on the day for actually the execution. So I then essentially, chilled out the next day and worked in my journal a little bit more, because that's got nothing to do with the strategy. It's just all to do with me not being on the ball, right? Um, and the number one important thing I would say about this, and it's one of the things I changed uh, many years ago, and it transformed my trading, which is essentially you need to stop looking at all the money you're going to make and start thinking about controlling the down days. It's so important, because if you're thinking about all the money and you're under pressure to make money, and you're risking money that you don't have, then you're really going to struggle to execute and just trade well. Okay, so what I would recommend is you take your average winning day, okay, and this depends on your percentage of average winning days um, versus your percentage of average losing days. And when you do lose, try and make sure you're not at least losing, more than 1.5 times your average winning day. Because the reason being is you need to get away from this boom and bust cycle, because essentially, it's quite common with traders where they'll continually take winning days, and then when they do actually lose, they end up wiping out a week's worth of work, and then it's very hard psychologically to get back and push that forward. Whereas if you look at your numbers and you say, right, on the days that I do my arse in and say I lose 1 to 2k, for example, your own risk thresholds is your own business, nothing to do with me. But say these numbers are arbitrary, but say you lose 1,000 on those max losing days, okay, and on those days where you lose 1,000, on the flip side, if you just lost 500 or 350, where would that be in? And on the days that you are profitable, is there any days that you get even close to your personal daily loss limit? Because if you don't, if the days where you do well, when you go from strength to strength and you tend to then put up good numbers, there makes no sense then to basically take your full loss, right? Because you know the probability of you returning when you're down, say, minus 7,800 on the day, getting back to break even in profitability for that day is pretty slim. Okay, so you need to look into those numbers and you need to factor that into your data, because I can tell you psychologically it's so much easier to come back with an average losing loss day than it is setting yourself back a week, right? It should almost just be like it's another day at work. Shit happens, on to the next one, right? You need to stop setting yourself back so much. And it's then back to the theory of a losing day and a losing week, to be perfectly honest with you, should never wipe you out. You know, I reckon that for the capital that you trade, you need to probably be giving yourself, 10, at least 10 losing days in a row, before you're probably out the game. And let's be serious, if you have 10 losing days in a row, it's just not going to happen. If you do, you're really off the boil, to be honest. That means you need to have 2 weeks where you cannot string a winning day together. And I know from my own numbers that doesn't happen, considering my winning days are above 80%, typically. Okay, so again, I'm in the boat as well of basically controlling the downside. It's the most important thing for traders, and I think especially scalping and day traders, because the cost of commissions and ultimately the risk that you're taking is the most important thing. Okay. Now you may be thinking, which journal do I use? I use TraderSync for this. Okay. I've used it now for a long time. Again, it's very much like an accounting software. Whichever one you use, you need to be familiar with it. They've actually done a really good update, literally in the last 24 hours, where it's a really good update. When I went to do my monthly and quarterly reviews, they'd done a nice snazzy update, so I was really pleased about that. Um, the other thing you should be measuring too is your average winner hold time and your average losing hold time. Just gives you an idea of how your performance is when you're in a trade. Do you tend to hold your losing trades longer, or do you tend to hold your winning trades longer? Just gives you another insight into how you behave when you're actually managing a position. And then, of course, depending on your trading style, you need to determine, is it better to have a static or a dynamic risk to reward. And what I mean by that is static being a very standard bracket order where you're, it depends on the products, say, ES 15 ticks to 15 ticks, or treasuries, 4 to 4, for example. Or are you going to be in the camp where you're going to actively micromanage the position? But if you do go in that, you need to have the data to back it up, because you end up might taking profits too soon, where you might holding on to your losing trades. So all of this again is back to data and back to understanding how you execute. Okay. So I hope this has been enlightening for people, and it's also nice, I suppose, for you guys to see just how I journal, how I perceive the market, and to see how we can push forward. There is a free trial to TraderSync in the link in this description as well. Complete transparency, I do get a kickback. If I'm honest with you, I actually don't even know what the kickback is, so it would be interesting to see what that is. But if you do want to get a journal and you're not journaling already, if you need one, it would be much appreciated if you could click on the link in the description. That would be great. Okay. So just to summarize, okay, I've made the summary pretty damn clear. Journal, journal, and journal. And of course, manage your risk, because if you're not doing this, you do not stand a chance against the competition. You know, do you think that it's month, quarter, and month end? Do you think Goldman and Citadel have just had a massive end of quarter review on the trades? You better believe they have. Okay, so if entities are doing it and they are managing the risk and doing all of this, why shouldn't you? Just because they're a larger entity than you and have more money and more resources, that doesn't mean that you need to just trade like a dick. You need to put yourself in the best position in order to make yourself profitable. You need to know the product that you trade. You need to be in sync with it, and you need to start believing in yourself. Now, I'm not saying you have an ego where you start going gung ho, but you need to have a certain belief in yourself that no matter what happens, you're going to consistently step up to the plate, make it happen, and push everything forward. Okay? So on that note, I hope everyone has a fantastic day. I'll leave some more links in the description. If you could do all the YouTube shit for me, please, and subscribe. And thanks to everyone that's been joining the coffee. Much obliged. It gives me the motivation to continually strive and push out the content for everyone. Okay, so everyone have a great day, and I'll see you in the next video. Okay, peace.